We all trust banks, and we put our money and savings in there. That's the safest way, right? Well, the recent events can totally change your opinion. The fall of Silicon Valley Bank, one of the most important banks of the tech sector in the United States, has alarmed the whole world regarding the safety and trustworthiness of banks. Before discussing its collapse, let's see who Silicon Valley Bank was. Silicon Valley Bank, or SVB, was not just another bank. It was the 16th biggest bank in the United States. Founded in 1983, SVB had survived through the dot-com bubble and the financial crisis of 2008. On the 10th of March, SVB had gone bankrupt, making it the second biggest bankruptcy in the bank sector of the United States history. Is it possible for such a big organization to fail, especially after the big lesson banks learned in 2008? Let's find out. First things first, the problem started during the period of the pandemic, where the interest rates in the United States were 0%. Money was so attractive, accessible, and cheap that companies were getting loans to achieve their goals. But when the Fed aggressively increased the interest rates in 2022, paying back the borrowed money became a burden. In just a single year, the interest rates went from 0% to almost 5%, and companies had to pay back way more money. That's an important reason that influenced the closure of SVB in two ways. Firstly, the companies that SVB had given out loans had difficulties paying the money back. Secondly, and what really had an impact on SVB, is the investment moves the bank had made. They invested a huge amount of money in what financial experts state that is the safest investment: bonds of the United States of America. And you may ask why investing in such a safe asset was wrong. Because interest rates influence the value of a bond. Let's see what really happened. SVB purchased bonds with a 1.5 interest rates for a 10-year bond. When the Fed increased the interest rates to 4.5%, their bonds lost value because of the interest rates difference. When you do the math, with an investment of $80 billion, the outcome will shock you. But still, this is not enough for a bank to declare bankruptcy. The only thing SVB had to do is to keep these bonds for 10 years until the maturity date and get all their money back. Everything started as it usually happens, from another bank's problems. Few days before SVB started having problems, another bank named Silvergate declared bankruptcy. Silvergate was a bank that had business only with crypto companies, so that shouldn't really affect SVB. What really affected SVB is the environment of fear that was created. A bank run took place because of Silvergate. A bank run is when people literally run to the bank to get their money. Yet again, SVB's deposits were $173 billion. No way so many people went to withdraw their money. The problem lies to the structure of banking today. Banks use the fractional banking method. To understand what this method is, we will briefly break down the banking system. Banks are companies that want to make profit, so they invest. They don't invest their money. They invest their depositors' money. But they can't invest every single dollar. They are forced by the government to keep a percentage of their deposits in cash. This percentage is usually 10% of the overall money the bank manages, but this differs depending on the bank. That means that SVB could have about $18 billion available for the depositors to withdraw. It seemed like SVB wouldn't face a problem, even if some depositors were influenced by the recent news. What really caused this catastrophe was the bank's announcement on the same day Silvergate collapsed, that they took strategic actions to strengthen our financial position, and they have sold substantially all of our available for sale securities. This action was translated into $1.8 billion in loss. So the bank, in order to be able to have available cash for depositors to withdraw, was forced to sell their assets with that damage. And that was the beginning of the end. Every single person ran to the bank to get their money out. The bank run was out of this world. As reported by Bloomberg, more than $42 billion were requested for withdrawal in a single day. Of course, SVB wasn't able to fulfill its clients' needs and was forced to shut down. After all this chaos, the United States government spread some good news. The FDIC, the department that protects the depositors' money, stated that not a single person will lose their money and that all deposits are guaranteed by this mechanism. To add on that, they even said that the money that will save the day do not come from taxpayers. And we all know what this means. Printing money. And what do printed money cause? Inflation. So the FDIC was forced to save the day, but may be destroyed tomorrow in order to show that the United States stands strong in every crisis. Our personal opinion is that inflation won't rise that much, as the U.S. government came to save the banking system and the money that was deposited. These deposits were theoretically standing idle in the accounts to make monthly payments, such as bills, rents, and salaries. They weren't invested in any assets to cause any economic harm. We feel that the banking system will see more crises as this collapse will cause fear in the whole world, since all banks use the fractional banking system. But we do hope that we won't see other big banks going bankrupt. What's your opinion on the SVB collapse? Do you believe we will have a domino effect? Let us know in the comments.